Hello friends. Today we will discuss about taxation on share market activities, share market transactions. Of late, we have seen lot of retail investors have increased their activities in the share market, particularly after COVID-19 pandemic hit us. People sitting at home opened lot of demat accounts. Around 4 crore demat accounts were opened in last 2 to 3 years. So these retail investors are new to the stock market. They are doing trading, but many do not know about the tax implication of the profit earned through trading or through transactions of stock market. As we know, there are 5 heads of income under Income Tax Act: income from salary, house property income, business income, capital gains, and income from other sources. Income from share market transactions can be of 3 kinds, except salary income and of course house property income. Income from share market can fall in income from other sources, under business income, or in capital gains. Yes, you heard it right. Income from trading in shares can be termed as business income. For example, take intraday trading. Intraday trading is nothing but you buy today and sell today, buying and selling on the same day. So the gain from intraday trading is taxable as speculative business income. It will fall under the income head of business income. Such gains are taxable at the normal tax slab rate under which you fall in. If your total income is in 10% tax slab, then the gain from intraday trading will also be taxable at 10%. If you are in 20% tax slab, then 20%, or if you are in 30, then 30% tax will be paid on gain from intraday trading. In case of loss from intraday trading, it can be set off only against the speculative business income. And even after setting off of speculative losses under speculative gains, if there is any balance left of speculative loss, it can be carried forward for next 4 years. In next 4 assessment year, it can be carried forward, and whenever you have speculative business gains, these losses can be adjusted and reduce the tax liability in that particular year. So this is how intraday gains are taxed. One more kind of trading activity is F&O trading, futures and options. Income from futures and options, gain from futures and options transactions are also treated as business income, but these gains are normal business income, non-speculative. These are not speculative business income. Again, these will be taxed at the normal tax slab you are into. Losses, if any, can be carried forward for next 8 assessment year. So these two kind of transactions from stock market are termed as business transactions and taxable as business income. Then next is capital gains. Some incomes fall under the head capital gain. Capital gain, as we know, can be of two types based on the time of holding of the asset, and in this case shares. If shares are held for up to 12 months, then these are referred to as short-term capital asset, and the gains or profits earned from sale of short-term capital assets, shares, are taxable as short-term capital gain. Short-term capital gains are taxed at 15% flat rate, irrespective of your normal tax slab rate. Short-term capital gains are taxed at 15%. In case of short-term capital loss, you can carry forward for 8 assessment year. In the next 8 assessment years, anywhere you have short-term capital gains, these losses can be used to reduce the tax liability in that particular year. Then the other capital gain tax is long-term capital gain. When shares are held for more than 12 months, then they become long-term assets, and the gain or profit earned from sale of such shares which are held for more than 12 months are termed as long-term capital gain. Long-term capital gains on shares are taxable at the rate of 10%. But there is an annual exemption of rupees 1 lakh. So if your long-term capital gain is 1 lakh or below in a year, then there won't be any tax. Long-term capital gain more than 1 lakh, then the amount which is above 1 lakh will be taxed at the rate of 10%. Your long-term capital gain is 1,50,000 rupees for the year 22-23. Out of this 1,50,000, 1 lakh is exempted, so you will be paying tax at the rate of 10% on balance 50,000, which is 5,000 rupees. Long-term capital losses also can be carried forward for next 8 assessment year. So this is how long-term capital gain taxes are taxed. Then there is a dividend income. Dividend incomes are taxable as income from other sources, and it will be added to your total income and taxed accordingly. According to the tax slab, it will be taxed like the business income we discussed. companies paying dividend for more than 5,000 rupees in a year will deduct TDS at the rate of 10%. If dividend is less than 5,000, then there won't be any TDS. If you have borrowed money to invest in shares and you receive dividend, in that case, the interest paid on such borrowed capital can also be adjusted against the dividend income. But there is a limit of 20% of the total dividend income can only be taken as deduction towards interest payment. For example, if you have received dividend for 10,000 rupees and you paid an interest of 3,000 rupees on the borrowed capital, then you can take rupees 2,000, which is 20% of the 10,000 of the dividend amount, as deduction. So 10,000 is your dividend amount less 2,000 interest, not 3,000. Only 2,000 can be reduced from the 10,000, and net 8,000 rupees will be taxed as dividend income, and it will be added to your normal tax slab, normal income, and it will be taxed as at your normal tax slab. So these are the 5 kind of transactions